Hey, it's the digital prisoner here. I've made an escape. I'm out on the run. You can hear the dogs out after me. They've let everything loose. They're chasing me down, but I knew I had to get you this information about money. Talking about money in the bank. So, um, I'm gonna try to find a place so that the dogs aren't all after me, and then I'm gonna get you this info that you need to know. All right, so now let's talk about buying and hope these dogs don't catch up to me. All right, so um, the barter system is to trade one good or service for another good or service. You can see an example here in this little cartoon. The caveman has a wheel. This one offers him an apple. He's like, no go. Well, here he offers him a bag of some good. He's like, yeah, no. Then he offers him, you know, looks like some kind of little axe or some kind of tool. Um, And so he winds up saying, I'll take the bag and the axe, and then you can have the wheel. So they had a barter. Okay, they made a trade. Money, something that serves as a medium of exchange. Well, what's a medium of exchange? Well, it's a good thing you asked. A medium of exchange is anything that is generally accepted as a standard of value in a particular country or region. Meaning that if I have rock of a black rock, if everybody understands that that black rock is equal to 4 chicken eggs, then we pretty much that would be a value, a medium of exchange. Hey, it's equal to that. Like we know, money, a dollar, what is equal to a dollar? So we have these various ideas of what things are worth. Bartering. Each person must have something the other wants. Some goods must be traded quickly, like seafood or meat, uh, or you risk it going bad. So if you don't trade off those chicken eggs quickly enough, well, they're going to go bad. Um, or if you killed a deer or a buffalo, if you didn't trade it off fast enough, that meat would go bad. So you wind up taking less than what you can get for it sometimes. And then some goods are hard to trade because they're so big. Like if I have a cow and I want to trade you for chickens, well, how many chickens are worth the cow? Well, it probably takes a lot of chickens to be worth that cow. So a problem develops because you don't want to give me, 100 chickens for my cow. So we have to come up with something that settles for an exchange. So instead of giving me 100 chickens, you give me $100, and $100 you buy my cow, and then I can take five of those dollars and buy five of your chickens. So you see, and it makes it easier. So this is what one of the functions of money is. It's this medium of exchange, or it's a standard of value. You can measure the value of a good or service with money. Okay. In Storehouse of Value, you can put the money up and it will maintain its value to be used in the future. Now, this isn't always true. Like, for instance, if you were let's say you were born in around 1970, and every day of your life you put up a dollar. Or let's say in 1970 you put up $100. That dollar isn't worth as much today as it was back in 1970. Okay, and that's due to inflation. It still keeps value, and you can put it up, and you still have $100. It's just not $100 is not worth what it was in 1970. All right, forms of money. Commodity money. Money that is a commodity has value as other things, such as gold coins, silver coins. Okay, these are money, but they are also valuable because they are a commodity such as gold. They are always will be worth something because it's made out of gold or it's made out of silver. Fiat money. Money that has value only because it's declared to have value. And this is what most of our money falls under. Our dollar bill. It's pretty much worthless except for that it is a dollar bill. It the money, the paper it's printed on, the ink, all that is really not worth the money. I couldn't go, and if I just handed this to you and you didn't know what a dollar was, you'd be like, I don't want that junk. Um, and this changed from coins, which were the commodity money, into um, these, bills for the most part. Now, so don't take me wrong, there are some bills that actually were printed or upon various types of money or had so much laced in it and different things. But for the most part, most of your bills were this fiat money. And then digital money. It's electronic money that can be used to pay for goods and services. And this is the era that we're getting into where you don't ever really touch your money. It's all digital. Your job automatically deposits it. You pay your bills online, you order from Amazon, and so forth, and you never actually see your money. The borrowers, credit. Access to borrowed money, a deferred payment for goods and services. And it's almost always with interest. If you find money that you can borrow without interest, that is a great thing. Uh, and credit is usually confused with money. Okay, credit is not money. You're borrowing money and you're paying it with interest. It's a way to buy things when you have no money. However, you have to pay interest on it for the most part. Um, and this interest is a payment made for the use of borrowed money. It's like, okay, you want to borrow $100 from me? Sure, I do. Um, so you borrow that $100 from me, and so at the end of the month, you need to pay me my $100 back plus an extra $10. And that was interest on that money. So you paid me 10% interest on, which is a high interest rate, but it's simple. So you pay me 10% interest on the money I loaned you after a month. Interest rate, which is what I just mentioned, is the amount of money that must be paid on top of the principal expressed in a percentage of the amount of money borrowed. Okay, so depending on how much you have and what interest rate you have, that's the interest that you're paying back in order to borrow that money. Interest rate. What factors go into creating interest rates? Opportunity cost. What could I have done with this money if I wouldn't have loaned it out? Inflation. How is inflation going to affect this? Transaction costs. Wages, expenses, background checks, document fees. What all am I going to have to do in order to verify that you're going to be able to pay this money back and that in good faith you're going to pay it in the interest? Future uncertainty. What's the likelihood that you're not going to pay this money, or that the money, something will happen and the money's not worth anything, so I'm out all this stuff? And then default risk, which is the risk that you aren't going to pay it back. There's short-term interest or loans and interest, which is paid back in 1 year or less. This is, like if you do, they send out a lot of these in mails. You got like these different loan companies who, oh, well, here, we'll loan you, $1,000. And, that's usually set up over a short period of time. Um, or long-term interest, such as, house, you borrow the money to buy a house or a car, and it's paid back in over a year. These are usually cars are anywhere from 3 to 6 years. Houses are 15 to 30 years. The interest on a long-term loan can be much more than on a short term, even at the same rates, especially if there is compound interest, which means that the interest continues to build. All right, so origins of banking started in ancient times when people needed a place to store excess grain. So they would take this grain that they had that was extra, and they would put it into this granary, and they would get some kind of marker that would signify how much grain they had. It had little markings on it, or various things, or various pieces that would show this is how much excess grain you have in this granary. They could then take that and they could trade it off to the blacksmith for something they needed from the blacksmith or the potter or whoever, or they could come back to the granary and turn that in order to withdraw some of their grain that they needed. Alexander Hamilton started the first central bank in the United States. Uh, then, for a while, no central bank existed. And then in 1913, the Fed was created. Banks today do a lot of various things. They collect deposits, they make loans, they do checkings accounts, traveler's checks, credit cards, money orders, safe deposit boxes, debit cards, notaries. So they do all sorts of functions that they offer in order to get you to bring your business with them. Here's a little terminology in dealing with this. A balance sheet, which is a statement of a person's or business's financial position at any given time. And your balance sheet shows your negatives and your positives. Um, and it will lay out to where if you are in the red or in the black. And that's where the terminology, if you ever heard somebody, oh, well, we're in the red, or oh, we're in the black, that black always meant positive because all your positive numbers were written in black, and the red were your negative numbers were written on your balance sheet. Uh, and so that's if you were in the red, you were negative, and if you were in the black, you were positive. Assets. These are things of value that a person or business owns. Liabilities. What a person or business owes, its debts. Net worth. That is your assets minus your liabilities, are also known as your equity. Fractional reserve. It's a fraction of the bank's customer deposits kept on hand in reserve to satisfy demands for withdrawals. Okay, a bank has to keep about 10% roughly, depending on what the Fed is dictating out, of its deposits on hand. The rest of it they are loaning out to people. Required reserve ratio. This is the minimum percentage of a total deposit that a bank must hold on at hand. Okay, so these two go hand in hand. That they got to have this for the deposits, but this is the ratio in which they figure out how much they have here. Excess reserve is the amount held back by the bank above its required reserve, which serves as money that is loaned out to others. And then full reserve banking is a system in which all deposits are backed up by the assets uh, with a store of vault. And these pretty much do not exist today. Balance peril. Banks must keep their books balanced to be able to cover its customers' deposits and extend loans. If a bank goes into the red, it cannot pay its debts. A bank run is a situation that occurs when many depositors show up at once and demand the balance of their deposits in cash. So if everybody, remember we just mentioned that they keep about 10%. So imagine if half the people that go to the bank there show up demanding all of their money. The bank won't have enough money to cover this, and this can cause a bank to close down and go into collapse. And this is something that's actually happened. There were a lot of bank runs in the past, which led to the creation of the FDIC, the Federal Deposit Insurance Company. Next time you're in a bank, look for this right here, and you'll see that the bank should probably have a little thing saying insured by the FDIC. It was created in 1934, and it insures banks. The federal government will give you your money back up to $250,000. So if you have $250,000 in this bank, that bank gets robbed or that bank goes down, the FDIC will give you your money back up to that amount. The Federal Reserve, the Fed, is what it's known as. Everybody calls it the Fed. It keeps the banking system stable. It regulates and watches what banks do. This is the government system that overlooks banks. It determines the required reserve ratio, that 10% we mentioned. It decides if they need to keep less on hand or if they need to actually keep more. They can force bank mergers. Uh, is the bank for banks? Banks borrow and loan or borrow and give money to the reserve, deposit money into the reserve. Most banks hold most of their reserves at the Fed. They can loan, and the Fed can loan money out to banks. It controls the money supply. Money supply is the amount of money in circulation. They use monetary policy, regulation of the money supply through various tools of the government action. Expansionary, they increase the money supply by purchasing government bonds, which puts more money out, lowering the reserve requirement, which means banks are going to loan more money, and reducing the federal interest rate, which then banks reduce their rates, so more people are going to borrow money and more money is going to get out there. If they're trying to reduce it, contractionary, they do pretty much just the opposite. They sell government bonds, pulling money in. They raise the reserve requirement, means less loans are being given out, and they increase the interest rates. The money supply, liquidity, ease with which an asset can be turned into its full cash value. Currencies, checking accounts, traveler's checks. How can I take everything I have and how quick can I turn it into cold hard cash? Um, Less liquid assets, savings accounts, property, debts. These are things I can't turn into money as quickly. And the money supply increases when currencies are increased and when banks loan out money in the Federal Reserve banking. So until next time, this is the digital prisoner saying deuces. Ah, no, no, don't take me back, no!